And joining us now to share his commentary on the day's market performance is Sam Houlie from Differential Capital. Sam, thanks so much for your time this afternoon. And let's start by talking about what we're seeing in markets. It does seem like trade has been, choppy. Yesterday, markets were mostly in the red. Today, we are seeing some green screens coming through. Our traders just holding off big bets ahead of, fresh market catalysts. We have the Fed minutes out tomorrow. We have the US retailers out. I think Home Depot out before markets open today, then Walmart out later in the week. Are we just at a hit pause kind of moment before those big moves?
I think you have it exactly right. I think the market is, I would say it's neutral in the sense that it's neither negative nor positive. But I'd imagine that the Fed certainly is in a very interesting position given the amount of pressure that the Trump administration has been putting on Jerome Powell. So we'd see how that unfolds. And then, of course, needless to say, there's been on the geopolitical front, there have been a few things happening. So I think it's really just a case of just allowing things to take their course over the next week or even 10 days or 10 trading days. And we'll see where we go. But I don't think it's a negative, but it's definitely not an overwhelming positive.
I think we're so used to these big shifts, these big moves in markets that have been happening over the past year or so, that when markets are neutral, you wonder what's going on. Is there something wrong?
Yes, I think it is true. And we have to go back. I mean, I've said this on the show before.
Yeah.
You go back to early April where we had the really big Liberation Day tariff announcement and the market sold off. I think that was the last time the market reacted in a very exaggerated fashion. Since then, the market has sort of said, well, we'll take a wait and see approach, which is why we've been in this neutral sideways movement, but mostly up. The market's, in fact, actually strongly up. So I think if you were to go back 4 or 5 months, the market, in fact, is overwhelmingly positive on how things are unfolding, but not euphoric, if that makes sense.
Yeah. Let's move over to some company news. Interesting company news that is Intel getting a much needed cash injection with SoftBank picking up a 2% stake in the group, that for about $2 billion. There seems to be some renewed optimism in the company with the new CEO taking over. There's also, talks around the US government eyeing a 10% stake in the group. What have you made of these moves? Especially, let's actually start off with SoftBank, and then we'll move over to what's been playing out when it comes to the US government. I mean, with SoftBank, I guess it doesn't come as a surprise, considering that they have been making investments into, companies that are likely to benefit from the AI boom.
Yeah. Yes, I think SoftBank has been an incredible case study over the years of picking the industries where they believe not only will there be a big impact, economic impact, but it's a large profit pool with a large addressable market. So semiconductors definitely falls in that. It makes perfect sense for SoftBank. SoftBank also have a history in terms of their founder of taking fairly big chunky positions in things that work out, and vice versa. Not every one of their investments have worked out. But you have to go back to some of the early meetings with the Trump administration where SoftBank made it very clear that they would be making a commitment to investing in the US. So there is a huge trend with the new administration to getting investments onshore in America, particularly in certain industries, of which semiconductors is one of it. Intel in particular, shifting to Intel, has lagged if you compare it to OpenAI and NVIDIA and all the others. So in this sense, I think that Intel was the smart move for SoftBank. And I think there has been some political pressure on Intel, given their history and their long checkered, they have a 50-year history of being a leader in that space. So I think for them to lag behind is not good. So all in all, I think this is good for the US, it's good for SoftBank, and I think it's a good deal. The bottom line, it's a very, very, very good deal.
And just your thoughts are then around the U.S. government's involvement, particularly in corporate America. You talk of the pressure SoftBank was feeling, considering that they've had talks with the U.S. government, and I guess they felt that, hey, let's stick to our word and invest in the company. We also see what's been going on with Apple, they've also been really investing and making
Yes.
pledges into investing into the US's production manufacturing capabilities. And then we have the talks now with, or the reports rather, that the US is looking at taking up a 10% stake. It does seem somewhat unusual, but I guess we are in quite unusual times, uncertain times.
Yeah, well, I think 6 months ago, I would have considered it unusual.
Yeah.
And we've had a few events now and a lot of talk from the Treasury Secretary of the US. So I think it is now becoming clear that the US has decided in certain industries, particularly in the AI revolution, that what they really want is they want the US technology stack to be the dominant stack globally. And they don't really want it to be sitting outside of the US. So if you frame it in that way, then it's very clear that it's important for the US administration, the current administration, to have investment in building the US technology stack and making it globally relevant. So in this sense, it makes perfect sense. And even if they were to take a stake in Intel, it's not a permanent stake.
Yes.
It's more of one of those, a strategic stake that will ultimately be offloaded to a player that will develop the US as opposed to, Taiwan, just as an example.
Yeah, no,
I mean,
no.
if you think of Taiwan Semiconductor, the point is that it's all onshore and the US technology stacks must be the dominant stack globally. That is now become incredibly clear, and every interaction should be framed and seen in that way.
Interesting times, Sam. And just before we get into the clips, BHP taking a knock today in terms of its earnings. This, of course, on the back of weaker iron ore prices, but they seem to be quite optimistic about their prospects. Just walk me through your analysis on those numbers.
Yeah. It's a fascinating result. The market, the numbers were mostly in line with very reduced expectations.
Yes.
The market's actually been really good in reducing the expectations. As you've already said, I mean, these are some of the lowest numbers, and we think it could be the trough of the cycle, the bottom of the cycle. BHP is useful because we like the result to be clean, and this is a very clean result. When I say clean, there's nothing funny in it. You can really, it's very informative. There's good feedback. The key point about it is the fact that their payout ratio of dividends is higher is a very important signal. The dividend itself is low, but the payout ratio is high. And even that tells us that they have strong confidence in the demand picture. So everything that we see in terms of the data on commodities is that in a lot of the markets that BHP plays, you have supply deficits. That takes a long time to play itself out. BHP has the capacity to ride it out, and therefore they're trying to invest into the demand as it grows. And the dividend is a signal that they are willing to do that. The extension of their debt facilities is another indication that if it were to happen that they're able to consolidate at the bottom of the cycle. I've been around long enough to know that these cycles are long cycles, and at the bottom of the cycle, which we are in, the strongest survive, and they make the super profits as you come out of the cycle. But you have to have the capacity. So I see that as almost an implicit signal to say that somewhere in the next 12 to 18 months, very high quality copper assets, potash assets, and other very important metals will become available, and BHP wants to mop it up. So I would argue that the 12 to 24 month outlook for commodities, and BHP in particular, in fact, is really good. So it's an idea that we like. We think this is the trough.
Okay. All right. Let's hit pause on the conversation before we move on to your stock pick. Let's take a moment to touch on what counters your industry peers are watching closely.
Yeah, so we have seen three of the local banks, report. Nedbank a little bit less exciting, Standard Bank good, and Absa reasonable. I think FirstRand's lagged a little bit, just given the whole commission saga around the UK motor finance. That, to a large extent, I think has been resolved in terms of the liability is much more understandable, and it is lower than I think the worst case that the market was pricing in. We haven't seen the share price recover. It is you're getting a good entry point, and I think the results will be reasonable. It's a strong franchise, and we are still quite positive on South African economic growth in the next 2 years, and the banks tend to be a good beneficiary. So you're getting a quality player at a reasonable price at a good point in the cycle, and that's why we like FirstRand here.
Bit of a special situation at the moment, with the recent transactions that they've done. Around 80% of their NAV is now sitting in cash. In fact, the cash portion, or the cash proxy portion of their NAV is, at a per share basis, is actually higher than the listed share price at the moment. So you're actually sitting with a bit of a cash shell here. There is obviously an option that they might do some M&A or put something back into that portfolio. But as of now, we are expecting a meaningful shareholder return. You're getting a discount right now, around 30% at the manager valuations, but it's in excess of 20% if you take into account the offer for the PIC core business that they've got. So good margin of safety there. So I think you get good optionality out of RateNet in the near future.
So RateNet and FirstRand, your analysis on those counters?
It's really easy. I agree 100% with both of those analyses and the investment hypothesis. As you know, we own both of those stocks, but RateNet is an idea that was a stock pick of mine quite a while back. That has played itself out partially, and I would say that it will now play itself out over the next 12 to 18 months. And I fully agree. So in both those cases, very good ideas. We have them in our client portfolios, and I agree fully.
And what else are you liking? Where else are you seeing opportunity this afternoon, Sam?
Yes, it is an idea that I mentioned before. It's Pick n Pay Holdings, and it's still a very good idea. I think the essence of the idea is that you have to start with the way the market is currently pricing Pick n Pay. So if you take the current market cap and you compare that to the market capitalization of Boxer, they own 65% of Boxer. The implied valuation of everything else in Pick n Pay is significantly negative. So there's a massive discount. So the market, in effect, at the current share price, is saying that Pick n Pay, outside of its Boxer stake, will make perpetual losses, and in fact is a bad investment. Now, the data that we have in our team, that we have access to and we're monitoring, and the recent result is in fact completely opposite to that, which is why we think there's a big mispricing in Pick n Pay today. So let me go through it. The first is, in the Pick n Pay core business, the company-owned stores, the like-for-like sales have steadily improved over the last 12 months. And if you think of the last 20 weeks, it's really been very good at about 4%. Now, 4% might not look good, but it is really good relative to where Pick n Pay was before. Pick n Pay clothing is really growing well. It's 17% growth in the last while. And then Boxer itself, which they continue to own 65%, is the fastest growing South African food retailer, and can continue to grow. It's growing as fast as ShopRite and others, and can grow a lot. So we think the market is possibly making a big mistake based on the data with Pick n Pay, and that if it were to rectify that and correct it, somewhere in the next 12 to 18 months, the results will confirm that the market has to reconsider Pick n Pay, and that's a much higher share price than we're currently seeing today.
All right, let's leave it there. Sam, thanks so much for your time and sharing your insights of trade at midday. Now, that was Sam Houlie from Differential Capital.